tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Welcome to the Power of Zero show. This is your host, David McKnight, best-selling author of The Power of Zero, Look Before You LIRP, The Volatility Shield, and Tax-Free Income for Life. If you're looking for someone to help you navigate all of the pitfalls that stand between you and the 0% tax bracket, and there's quite a few, by the way, head over to davidmcknight.com. Happy to connect you with a member of our elite POZ advisor group, among the very best tax-free retirement specialists in the nation. They're trained, vetted, qualified personally by me. And if you are a financial advisor looking to level up your game and adopt Power of Zero principles into your financial planning process, head over to powerofzero.com, opt into the free three-part video series, and we're happy to talk with you at any point during that series. If you're looking for any of my books in bulk, head over to davemcknightbooks.com. You can mix and match titles and achieve bulk discounts. Okay, today we are going to be talking about the two primary uses of the LIRP and the Power of Zero planning process. Now, I have to sort of preface this by saying there's dozens of different contexts in which life insurance gets used. But 95% of the time in the Power of Zero planning process, it gets used in two different ways. The first way that it gets utilized is when you have too much money in your taxable bucket. Now, we're going to talk about 5 different ways that you can sort of skinny down a bloated taxable bucket, only one of which is life insurance or the LIRP. But it can be very useful because the LIRP it has a lot of the tax-free attributes of the Roth IRA without any of the limitations of the Roth IRA. But it's not the only way to skinny down that bucket. And there's actually 5 different ways, and we're going to talk about that. But first of all, let's say you had $1 million in your taxable bucket. What's wrong with having $1 million in your taxable bucket? It sounds like it would be great. It's liquid. You can access it. But from a Power Zero perspective, what's the real problem with that? Well, we know that when you take the inefficiencies in the taxable bucket and you amortize those inefficiencies out over the balance of your lifetime, it could end up costing you hundreds and hundreds of thousands of dollars. Okay? And this is why we say taxes in the taxable bucket are an optional tax. You don't have to pay them. You pay them because you choose to pay them. It's an optional tax. So there are a number of different ways that we can skinny down this bucket to the right amount. And what is the right amount? In a rising tax rate environment, we want 6 months of basic living expenses. Guess what? In a level tax rate environment, how much do we want? We still want 6 months of basic living expenses. But it's particularly poignant that we get this right in a rising tax rate environment because every year that goes by, you pay more and more tax to the IRS that you didn't really otherwise have to pay. So let's talk about the different ways that you can skinny down your taxable bucket. The first way is that you can utilize your taxable bucket to pay for your lifestyle. What do I mean by that? Let's say that you are in retirement, you want to do a Roth conversion, and normally what you would do is you would say, let's say your lifestyle requires $100,000, you would distribute $100,000 from your IRA, and then you would perform a Roth conversion on top of that. And let's say that's $200,000 per year. So now all of a sudden you've taken $100,000 out, that goes into your taxable cylinder. And then you take another $200,000 out for a Roth conversion. So now all of a sudden you're bumping up into a tax bracket that gives you heartburn. You're paying much more to the IRS than you otherwise could have had you maybe paid for your lifestyle out of your taxable buckets. So this is a great opportunity. You take your least valuable asset, your least valuable bucket, which is your taxable bucket, utilize that to pay for your lifestyle, do the Roth conversion, stay in a much lower tax bracket for your Roth conversion purposes, and that allows you to keep more of your money, inside your tax-free bucket ultimately. So that's the first way that you can skinny down your bucket. The second way is to maximize your 401k or preferably your Roth 401k at work. So let's say that you want to fully fund your Roth 401k. Well, actually, really the only way you can do it is have that money withheld from your paycheck. It gets contributed directly to your Roth 401k. Well, the problem here is that you can put $27,000 per year into your Roth 401k. Your spouse can put $24,000 per year into their Roth 401k. That's $54,000 per year. If you're having $54,000 per year withheld from your collective paychecks, then all of a sudden you don't have enough money left over to pay for your lifestyle. So that can be a problem. So what you may be able to do instead is if you have that $1 million, for example, in your taxable bucket, why not compensate yourself for what you would have otherwise taken out of your paycheck and spent on your lifestyle, but otherwise put into your Roth 401k? make up the difference out of your taxable bucket. So you're spending down your taxable bucket. You're basically compressing it down, getting it down to the right balance. And in the meantime, you're putting the maximum into your Roth 401ks, which in this case, $27,000 for him, $27,000 for her, for a total of $54,000. So that's a great way to skinny down your taxable bucket if it's too bloated, too large. The third way is to simply contribute to the Roth IRA. We know that if you're over age 50, you can put in $7,000 into his Roth IRA, $7,000 into her Roth IRA for a total of $14,000 per year. This is a no-brainer, folks. If you're making less than $214,000 of modified adjusted gross income as a married couple, this is a total no-brainer. You should not let a year go by where you're not contributing to the Roth IRA. Remember, the Roth IRA is the one thing that the federal government loves and Americans love. Why? Because the federal government gives them more tax revenue today. And for us as investors, we know that we're at historically low tax rates. So yeah, we'll put after-tax dollars into that Roth IRA. But as tax rates creep up, as time wears on, we're going to be able to take those dollars out tax-free. The fourth way to skinny down a bloated taxable bucket is by using those dollars to pay for the taxes on your Roth conversion. Now remember, if you're younger than 59 and a half, the only way to do a Roth conversion is if you have money sitting in your taxable bucket that you can earmark for the tax on that Roth conversion. Remember, if you try to have the IRS withhold the tax from your Roth conversion and you're younger than 59 and a half, you will get a 10% penalty. Even though you're taking that money out and you're giving it right back to the IRS in the form of a taxes, if you're younger than 59 and a half when you do so, you will get a 10% penalty. Now, if you are older than 59 and a half, you can have those taxes withheld directly from the Roth conversion itself. I wouldn't recommend it because if you have $1 million in your taxable bucket and it's languishing there and you're paying taxes on it each and every year, why not use those supremely inefficient dollars to pay the tax on that Roth conversion, therefore allowing the entire Roth conversion to make it into the tax-free bucket. So you've killed two birds with one stone there. You have spent down your taxable bucket, which is your least efficient of all investments, and you've maximized the amount of money that can go into your tax-free bucket. Okay, and the last way that we can spend down a taxable bucket that has a balance that's far too high is by way of the LIRP. Now remember, the LIRP is a bucket that has all of the benefits of the Roth IRA without any of the limitations or the constraints of the Roth IRA. We know that the LIRP has no contribution limits. I got clients that do $50 a month. I got clients that do $200,000 per year and everywhere in between. There are no income limitations. So remember, with the Roth IRA, you start making north of $214,000 of modified adjusted gross income. You can no longer do a Roth IRA. You don't have any of those income limitations when it comes to the LIRP. By the way, in a Roth IRA, you have to have earned income. So my kids, for example, my 7-year-old cannot contribute to a Roth IRA. He works, I just don't pay him. We also know that the money grows safely and productively. This is an important thing because I think that the LIRP, it's not designed to compete with your stock market investments. It is designed, however, to serve as a bond replacement. Okay, so you could reach into your investment portfolio, pull out the bonds, is what Tom Hegna says all the time. Pull out the bonds, replace them with an LIRP, and you will get greater return, lower risk, lower standard deviation. It's just a more effective way to grow your money as a bond replacement. So your money's going to grow safely and productively. And guess what? If you can grow, let's say you can grow your money between 5 and 7% without taking any more risk than what you're taking in your savings account, that is a safe and productive way to grow at least a portion of your retirement savings. We also know that you do not receive, the money does not show up as reportable income on your tax return. That means it's not taxed as it grows. And it's not taxed when you take it out. It does not count as provisional income. It's not going to count against the thresholds which cause Social Security taxation. And we also know that the death benefit doubles as long-term care. We're going to get into this a little bit more here in a second, but that's a huge deal because a lot of people, they say, hey, Dave, the death benefit's great, but it benefits somebody after I die. In this scenario, the death benefit can be spent in advance of your death for the purpose of paying for long-term care. I'm not in any way saying that having a death benefit that benefits your children is a bad thing. But a lot of people who get to the point in their life where their kids have moved out, their house is paid off, they're in retirement, they don't really feel like they need that death benefit. But if they can get that death benefit while they're alive for the purpose of paying for long-term care, then that sort of takes the sting out of it. And the last thing I want to touch on with the LIRP is it can be much more efficient than simply growing dollars in the tax-free bucket. So for example, if you are working with a member of our elite POZ advisor group, they're going to run a side-by-side comparison. We have very special software that we use to show this, but they're going to run a side-by-side comparison between the LIRP and a comparable taxable investment. They're going to show you money accumulating in both accounts, and then they're going to show distributions out of both accounts somewhere down the road, maybe 15, 20 years down the road. And so with the LIRP, instead of earning 8% and then giving 3% of that growth back to the IRS in the form of a tax and then keeping 5% for yourself, what you're doing is you're keeping the full 8%. You're giving 1.5% on average per year over the life of the program to an insurance company, and you're getting something useful in exchange for it. What are you getting? You're still getting the death benefit that doubles as long-term care. By the way, you still enjoy all the benefits that we talked about previously, tax-free distributions, safe and productive growth, etc., except now you've solved the long-term care quandary. People aren't opposed to having long-term care insurance. They're just opposed to paying for it. And what we did is we just took dollars from an account, your 401k IRA, where you were already paying 1.5%, whether you realize it or not. And we shifted those dollars to an account, the cost of which is 1.5% on average per year over the life of the program. And now all of a sudden you have long-term care. And should you die peaceful in your sleep 30 years from now, never having needed long-term care, guess what? Someone's still getting a death benefit, probably your kids. So there isn't that sensation of having paid for something that you hope you never have to use. So in summary, today we talked about the two principal ways in which the LIRP gets utilized in the POZ planning process. And like I say, it's probably 95% of the time it's going to be utilized in one of these two ways, either as a Roth alternative, way to spend down your taxable bucket, way to help you skinny down that bloated debt balance and get those dollars growing in a tax-free way. And like I said, we can show you hands down in a side-by-side comparison how the LIRP far outstrips a comparable taxable investment. Or we utilize the LIRP by peeling off a portion of your shift from the tax-deferred bucket to the tax-free bucket and utilizing that money to enter into an LIRP where you get all of the tax-free benefits that we talked about, but you also get a death benefit that doubles as long-term care. And of course, like I said, should you die peaceful in your sleep 30 years from now, never having needed long-term care, then your kids are going to get a death benefit, or maybe even your grandkids. Okay, folks, that is the show for today. Once again, if you're looking for someone to help you navigate all of this, help you implement these principles in your retirement so you can mitigate tax rate risk, you can also mitigate longevity risk, which, as we've discussed in past episodes, is a risk amplifier or a risk multiplier. If you want help navigating all of this and mitigating longevity risk and tax rate risk in the very same financial plan, head over to davidmcknight.com. That's davidmcknight.com. And if you are an advisor who wants to level up your game and adopt these principles into your practice, head over to powerofzero.com. Opt into the free 3-part video series, which teaches you how to transition your practice to a Power Zero type practice. And at any point during that video series, you can click on the link and set up a call with us. We're happy to have a chat with you. All right, that's the podcast for today. I really enjoy you being with me week in and week out, and I look forward to chatting with you same time next week.